If you're interested in real estate without 2 a.m. phone calls, repairs, or even having renters, REITs offer exactly that. It's passive real estate for busy firefighters. Today's episode, we're going to talk about REITs. It's basically real estate without actually owning the building. By the end of this episode, you know what a REIT is, the difference between that and having a rental yourself, if it's the right option for you, and some other considerations. Many firefighters have real estate. You'll hear things, the coffee table, from Airbnbs, flipping houses, having long-term or short-term rentals, all those things of that sort. But not everybody is equipped either with the skills to be able to do that, the contacts for subcontractors to fix things up. They don't want the headache of renters. They don't want the headache of people squatting in their place, other liabilities associated with it. So REITs, or real estate investment trusts, is a great solution for that. It gives you the diversity of being involved in real estate without actually the risk associated with all of those negative things, or that maybe sort of some stuff that's kind of outside your wheelhouse. So we'll dive into that today and talk about it. What is a REIT? REIT, or REIT, stands for Real Estate Investment Trust. And it's basically a trust comprised of folks that invest into it. And that trust itself owns anything from apartment buildings, data centers, residential housing, commercial buildings, anything you can think of with real estate. REITs can own these different things through their trust. And so you can invest in these REITs or in these trusts and earn money back from them. We'll get into a little bit more of the specifics. So getting involved in a REIT means you basically buy shares into the trust, the same way that you would buy stocks. The trust itself manages the tenants, they collect rent, they do repairs, and they pay you dividends based on how the trust is doing. Let's talk about 3 different types of REITs. An equity REIT owns the physical property itself, and this could be split up into different types of categories. It could be residential, it could be high density apartments, it could be industrial, it could be commercial, it could be data centers, it could be medical facilities. With this particular one, you're buying into a specific type of area or even a group of areas, and they physically own the property themselves, and they pay you the dividends from your shares. A second type of REIT is a mortgage REIT, and these ones are a lot more risky. So the advantage of this is that you could get a higher dividend potentially, but these ones, they don't actually physically own the property themselves. They own the mortgage. And a lot of folks who own REITs during the 2008 housing financial market crash and the housing associated with that ended up losing a lot because their mortgages ended up going under, and they didn't recuperate the same kind of money that somebody would from actually owning the physical property. The third type of REIT is a REIT ETF or mutual fund, and these types of REITs own multiple underneath them. So they basically own multiple REITs within that ETF itself. So it's a good way to diversify across it. So think of it like a S&P 500 index fund. You don't actually own the properties that are giving you the dividends, but you own a piece of each property through the ETF. So this is the simplest plug and play type of thing that you can do. Just buy the ETFs, and Vanguard, Schwab, a lot of those different brokerages offer their own specific REITs for different areas. So let's talk about pros and cons of having real estate or the actual REIT itself. So some advantages of the REIT, like we already discussed, was that you're not paying property taxes, you're not having to manage rentals, you're not having to deal with repairs, you're not having to deal with phone calls at 2 o'clock in the morning, and all the other headache stuff associated with physically owning the property. Although there are some downsides, there are some advantages to owning real estate. So physical real estate itself has several advantages. Some of them we've covered in other episodes would be significant tax implications and benefits that you have from it. The actual property that you physically own as an asset, the fact that it appreciates as an asset, and that you can use that as leverage to purchase other real estate or other types of things for other business ventures. A good practice is if you're working into maybe early in your career, you're working into trying to get some investments. Maybe you got some index funds, maybe you've maxed out your deferred comp, things like that, and you're looking to get into real estate. A REIT may be a good option for you to start off with because you're not actually having to put up a ton to make a down payment. You're not having to commit to something that you have to stick with for a long period of time, and a mortgage and other things that are associated with your credit. You could sort of just plug and play on the easiest form of buying a REIT ETF or a REIT mutual fund. And then from there, you'll be more engaged in following the actual housing market and commercial market, things like that, and how all that stuff ties into the real estate. So it's a great way to kind of start off. Once you've built that up, maybe you start, proceeding towards the actual physical owning of the real estate itself, and then seeing all the other benefits you can get from that. So some advantages of the REIT also from a monetary standpoint on what you can get from them. Typically, the rate of return on these stocks are anywhere from that 8 to 12%. Obviously, it's tied to the real estate market, so there can be ups and downs with that. But 8 to 10 or 8 to 12% is pretty standard for these. And then the dividends that you get on top of them, which are basically your quarterly or annual payments that you get back from these REITs is anywhere to 3 to 5%. So there are some significant advantages of having this, especially if you keep it in the long term. Different options for buying REITs would be the same kind of options you have for any other stock. You do it through a brokerage account, you can do it through your IRA, do it through your 457 if you self-direct any of those types of things. Some of the simplest things you can do when purchasing the REITs would be looking, and just same thing you would do through your index funds, just Googling the top best five S&P 500 index funds. You could just Google the best top 10 REITs that exist. And then from there, you could decide which one you want. You could go more specific and say, hey, I want to focus on data centers, or I want to focus on commercial or residential real estate, depending on what type of thing you want to do. But the easiest one is to just plug in something like a Schwab or a Fidelity or a Vanguard REIT that covers an ETF that covers the majority of these things, so you have pretty good exposure and you're reducing your risk. So some common mistakes some folks make are chasing the REITs that have a higher yield. We were talking about these a little before, but the actual REITs that own the mortgages themselves or own the loans, they are much more volatile. So you could get a higher rate of return potentially, but they also have a much higher risk of dropping out underneath you versus some of the ETF REITs. So that's one disadvantage of it. Another one would be is if you're buying and selling these things in a gambling fashion for the stock market, instead of buying it and holding it for at least a year. The longer that you keep these, obviously, the better it is for you. But from a tax implication part of it, the short-term gains, capital gains, are going to pay a much higher percentage than you would for your long-term gains. So if you are going to purchase these and you made a good decision to do so, holding on to them for at least a year would be in your best interest to minimize some of those capital gains taxes on it. So REITs offer a pretty good alternative to actually physically purchasing real estate in and of itself. You have dividends you can get from it. Some of these, obviously, these ETFs and mutual funds can go up in value as time goes on, and you aren't having to deal with the actual risk of renters collecting rent, fixing things, dealing with 2 a.m. phone calls, squatters, all the other negative things associated with owning a physical piece of property. So it does get you into the real estate market in a very, very simple way. Let's go through some common questions. So a common question is this real estate? And the answer is yes. You're not physically owning the property itself, but you are buying into companies that own significant portions of property. So it's a great way to diversify and get into real estate. Can REITs crash? Well, the mortgage ones are much more susceptible to this, and your REITs can go down in value significantly, especially as interest rates climb. So that's something to be very cautious of. But it's the same kind of attitude here from a lot of folks, saying real estate is very, very secure in the long term, right? Folks are always going to need a place to live or a place to conduct business. So REITs would be strong for you and secure for you in the long-term piece of it, the same way it would be by getting into the stock market. Short-term, you may have some drops, but long-term, it is advantageous to be involved in. Are REIT dividends guaranteed? The answer to this is no. Just like you would get dividends from any other type of blue chip stock or any of those large companies that pay out dividends, they're not guaranteed. They're tied to how well the company is doing, right? So if the mortgage rates are lower and the property values are increasing and they are filling those properties, obviously they're going to pay out more dividends. If the interest rates go up or there's an issue with real estate, then much less likely to be getting dividends from those companies. REITs give firefighters a great way to get involved in real estate without actually having to be a landlord. You get dividends from it, you build long-term wealth, and you're able to have an exposure to real estate where you otherwise might not have the opportunity to, especially if you're looking at getting a 20% payment down to buy a rental property or something like that. Great way to get involved in real estate without actually having to have the risk associated with it. Download the REIT quick guide in the description below. Thanks for joining me on Finance for Firefighters. Same as always, thumbs up if you like it, comments below. Hope you guys have a good shift. I'll see you in the next one.